Aloha. My name is Olivia Schubert, and I'm the chair of the Young Professionals Network on Oahu this year. The mission of our YPN is to create opportunities to grow the future of our careers and the industry and to perpetuate professionalism in the industry. To accomplish that, we're a group of young professionals who meet often to exchange business ideas, learn from one another, and to really give back to the community and improve our industry. I encourage everyone here to talk with all of our YPN volunteers here today at the trade show and to learn more about the YPN. This morning, I have the pleasure of introducing our first speaker, Mike O'Malley, partner with the law firm of Goodsill, Anderson, Quinn, and Stifel. Mike graduated from Harvard Law School, where he was editor-in-chief of the Harvard Journal on Legislation. Following graduation, he practiced with a Wall Street firm in New York City for 4 years, then returned home to Hawaii and joined the Goodsill firm, where he became a partner in the firm's corporate and tax groups. He rejoined the firm in 2008 following a 15-year hiatus, during which he was a partner at another Hawaii law firm. Also, Mike O'Malley and Goodsill, Anderson, Quinn, and Stifel has joined the Hawaii Association of Realtors as our new legal counsel in 2017. So please put your hands together and welcome Mike O'Malley.
Aloha. The fourth island, and I finally have a woman give me the lei. I've been waiting for this day, so no offense to the guys. It's nice to be here. I'd like to give you my version of my bio. Born and raised in Kailua, went to Damien, got kicked out, graduated Kailua High School, Claremont McKenna, summa cum laude, Harvard Law School, tax lawyer on Wall Street. Oldest daughter born in '84, came back, Goodsill, McCorriston, PwC, Acuity, back to Goodsill. So I obviously can't hold a job for very long. But it's really nice to be here, and it's nice to, before we get going, I'd like you guys to all give a big round of applause to the staff at HR. They've taken such good care of us for the last 4 items. They've done a great job. And believe me, for them, it's like herding cats, trying to keep us going in the right direction. When I started, well, let me start with the disclaimer, because Susan mentioned to me that after one of my presentations that a couple of realtors came up to her and said, he really doesn't like President Trump. I'm going to comment on the tax proposals. I'm really not political. I'm not Democrat. I'm not Republican. If I offend anyone, I'll apologize in advance. My comments come from a guy who's practiced tax for 36 years and has never seen anything like we've seen this summer. So I don't know what to say. So that's where the frustration and some of the joking comes from. It's not meant to be ideological, so I apologize if I offend any of you folks. I'm going to give you a 30,000-foot overview on what we know so far. And it's not a whole lot more than what we knew when we started this 4 weeks ago. The president does promise us that his tax reform plan is going to be phenomenal, and it's going to be huge. It's going to be huge. We don't know a whole lot more because all we have so far is a 2-page bullet point with some outlines of concepts. We still don't have a tax bill, and they're talking about getting tax reform passed this year. I will tell you that the normal timetable for passing tax legislation, we're way behind what that would require. Normally there would have been a bill of 800, 1,000, 1,200 pages that we would have been looking at for the last 3 or 4 months and talking about and lobbying and going back and forth. And despite the president's promise to drain the swamps, the alligators on K Street are alive and well, and they're out there protecting their various interests. But we don't even have the language of a bill, and that makes it really difficult because I can talk to you about concepts, but when it comes to tax, just like anything else, the devil is going to be in the details. So we don't have a lot of details. The other thing I wanted to tell you is that the president's tax reform proposal, as we understand it, depends very much to a great degree on repealing Obamacare, because that's where the tax savings would come from. It's still been unable to do that. The latest news you guys probably heard, President orders the Senate to stay here and do it. I don't see how they're going to be able to do it. They don't have the votes. You have Republicans, and the reason is, well, there's a couple of reasons, and I'll blame the Democrats too, because they're just sitting there like Cheshire cats, going, ha ha ha, let's watch these guys melt down. But on the Republican side, there's two problems. You have the guys who say it doesn't go far enough, right? And then you have the guys who say it goes too far and it's going to hurt my constituents. And you have Republicans up for reelection. They don't want to go back to their home states and explain how a lot of guys lost their insurance. So it's a real political conundrum. If you ask me today what I think is going to happen, I don't think anything's going to happen. I don't think they're going to repeal the Obama care health care law, and I think what will happen is the health exchange. It probably looks like we're going for a train wreck where the health exchanges will start to fail because something needs to be done. Whether you repeal them and replace them with something entirely different, or whether you fix them, but the status quo doing nothing is not sustainable. Something's got to happen. Hopefully, both sides will wake up and do something for the American people because right now they're playing politics, which that's what they do. So it's pretty difficult to see how any of this is going to happen in terms of tax reform, because without ACA repeal and the tax savings that the Republican bill relies upon, a lot of what they're talking about can't be achieved. Because remember, we have a balanced budget act, right? If you reduce income over here, revenues over here, you have to gain them over there. You cannot, you have to balance the budget anytime you touch the tax code. And that's the conundrum. Okay, I wanted to talk before we get into tax just generally about the broader Trump mandate and proposals. Okay, first thing, taxation, not an easy task, special interest. The K Street boys are out in force. Infrastructure, this one is, there's going to be something. He promised an infrastructure spending bill of $1 trillion. And I think we all agree that America has a big infrastructure problem and we need to spend a lot more. How he comes up with $1 trillion remains to be seen, but I think we can expect some real spending on infrastructure, which would be good. Trade, the president has discretion on trade. I will tell you that of all the areas, this is the one that scares me personally the most because this is the one where I believe he might create the most havoc in terms of world arrangements. It's a global economy, whether we like to admit it or not. And it's easy to say America first, and I understand that. But when you unilaterally go and upset longstanding trade arrangements, that could have unintended consequences. So it makes me nervous. He could be entirely right, and I don't know. But trade is an area where the president has a lot of power. There are some countries that stand to lose: China, Mexico, Korea, South Korea. He talks about building the wall, etc. So we'll see what he does on trade. He's pulled out of the Transpac. Energy is an area where he has a lot of discretion. Climate change, he's pulled out of the Paris Climate Accords, and I take no stand. I'm not up here to say anything about science of global warming or what have you, but I will suggest that it makes you wonder what side we're on when the only three countries on the earth that are not a signatory to the Climate Accord are Nicaragua, Syria, and the United States. I'm not sure that's the company we want to keep. So that makes you really wonder about what's going on. Anyway, he's pulled out, so we'll see what happens. Regulation, this is an area where he wants to deregulate. I think we all can agree, I certainly can as a lawyer, that we're way overregulated, I think. We drives ourselves crazy. I know that your industry alone is overregulated. It's just hard to keep up with it. It's expensive. It's never ending. So he's actually had some impact. He's put a kibosh or a hold on over 600 proposed regulations, federal regulations. So we'll see what happens. The devil, again, is going to be in the details, what gets tossed and what gets kept. But that's an area we can expect a lot of activity. And then, of course, immigration, which has been pretty controversial. And Hawaii's played a pretty formidable national role in this. It's gone back and forth, back and forth. The latest was he got the U.S. Supreme Court to agree that he could impose his ban, but not as to families. And he defined families pretty narrowly. We went back, Hawaii went back to the Ninth Circuit, and they said no families includes a broader concept, aunties, uncles, grandmas, grandpas. We have the sense of ohana in Hawaii. So our definition of family is broad and inclusive. So that'll go back to the Supreme Court and see what happens. The thing that's funny about that is that whole issue about immigration and the ban was to give the government 90 days to figure out what to do. And all the back and forth between the U.S., between the Supreme Court and the various courts, we're way beyond 90 days, but we still don't know what we're going to end up doing on that. So that's an interesting situation. So we'll see what happens. So let's get back to tax. These are the ways that the tax laws could change under the Trump plan. Number one, he wants to reduce the number of brackets. And I'm not going to read or go over every slide because you can go through your slides and it'll show you this stuff. But there are too many brackets right now. Brackets just means tax at what rate. So you have zero bracket taxpayers, you have 10% bracket, and on. We have 7 or 8 right now. He wants to reduce it to just 3 brackets. He wants to eliminate the head of household status. That gets me a little excited, only because I used to be a single dad with 5 kids, so I would have gotten killed under his proposal. But I'll tell you, the head of household taxpayers stand to lose under his proposal. Other guys tend to, most people will get a little bit of a break, and I'll show you the wealthy people get the biggest break. He wants to simplify the deductions, exemption, itemization puzzle. We're supposed to be a self-reporting tax system. And I don't know about you, but I've been a tax lawyer for 36 years, and I don't fill out my own tax return. Are you crazy? It's too hard. I get one of my CPA friends to do it for me, and then a massage around the edges where I know it can make a little bit better. I'm not gonna rely on TurboTax. Those guys are a little bit too black and white for me. Anyway, and then he's going to repeal the alternative minimum tax, which I think is good. He has some good ideas in here. Alternative minimum tax was a tax that was introduced in 1980, Ronald Reagan, when there were headlines in the New York Times about how gazillionaires and wealthy multinational companies were paying zero tax because crafty Harvard tax lawyers like myself were helping them pay zero tax. And people said, that's not fair. They should pay something. So the alternative minimum tax was a separate tax that once you went through the regular system, if you came up with zero, go back to alternative and try it again. And we're going to take away some of the exemptions and credits, and then you pay something under the alternative system. So everyone pays something. That's the good news. It made sense. The bad news is they've never indexed those brackets since 1980, over 30-something years. So what's happened? 35% of us are now alternative minimum taxpayers, and we're not the guys that this tax was aimed at. I'm sure a lot of you in the audience pay alternative minimum tax, and it's crazy. It's just not meant to be that way. So, and Congress is loath to get rid of it. Why? Because it brings in dollars, and people don't understand it, and taxes are really complicated. So, the good thing to do would be to repeal it. He wants to lower tax on business income. I'll talk about that. The corporate income tax rate is way too high in America compared to other countries, whether or not, and the thing that bothers me about the financial press is they use corporation as a buzzword for evil. All you have to say is corporation. Whoa, yeah, that's bad. Corporate's bad. Corporations are just an entity. But the corporate income tax rate in America is way too high. I'll talk about it, and he wants to reduce it, which is a good thing. He wants to lower taxes on investment income, which is probably a good thing. He wants to repeal the ACA. Again, I don't see a way to that. Repeal and replace. We don't have any replacement in sight. Repeal and replace later. That ain't going to happen, I don't think, because if they do that, if they repeal and then get around later to replacing, 17 million Americans projected to lose their insurance in 2018 if that happens, and up to 26-30 million in the years out after that if they don't get around to replacing. A couple things not on the slide. He wants to replace the estate tax with a capital gains tax. I'll show you how that works. And he's talking about eliminating 1031 like-kind exchanges. So all the realtors in the audience, wake up, because you guys know about that. Don't worry. I don't think it's going to happen. Don't call my office and say, you promised me it wouldn't happen. But it's highly unlikely. It's been around for a long time, and his proposal seems like kind of cockamamie. I will say one thing to all you realtors, and this is not a tax thing, but when you represent the seller in a deal and you draft your first contract, your first proposal, always, always, always put in there seller intends to do a 1031 because you can always back off and forget about it, but you can't unscramble the egg. If you get halfway down to closing and money's changed hands, and then you decide, ooh, I want to do a 1031, it can be a little too late. So that ought to just be standard operating procedure. Okay, so this slide just shows the difference between the current, which is the left column, and then Trump and the House GOP. You can see the House and Trump are pretty similar on most things. The difference between Trump really doesn't have anything on capital gains. The difference between 23.8 and 20 just means that he wants to get rid of that 3.8% on investment income, which gets lopped on top of the 20% current capital gains rate. So he really wouldn't touch capital gains. The House would provide for a 50% exclusion of capital gains. So not necessarily a different rate, you just exclude half the rate, half the capital gains, and with the top rate of 33%, half of 33% is 16.5. That's how you come up with the number. Okay, top corporate rate, he wants to reduce it from 35%, where it currently stands, to 15, the House 20%. Both want to repeal the AMT. Itemized deductions are kind of interesting because Trump wants to just impose a cap on itemized deductions, 100,000 for single filers and 200,000 for joint married filing jointly. The House wants to repeal all deductions. They always say all, but, and it's always the but. And you notice the two buts: charitable deductions, because the nonprofit charity lobby is very strong, and that would be a real problem if you lost the deduction for charitable contributions. And home mortgage interest. They are not going to touch home mortgage interest. You don't have to worry about that. That's the third rail of politics. There's a concept in tax called the tax expenditure budget. It was a concept created by my law professor at Harvard, Stanley Surrey, who was the number 2 guy at Treasury. And his notion was simple. Guys, we need to measure the impact of tax rules. Because when you make a tax rule that reduces the amount of money that government gets, it's the same as if the government got that money and wrote a check. So we need to count. And the tax expenditure budget is just a fancy way of saying, let's count the impact of these various credits and deductions. Well, guess what the largest expenditure on the tax expenditure budget is? It's the home mortgage interest deduction by a long shot, because it's worth a lot to a lot of Americans, a lot of households, and for many, if not most Americans, their home is the most valuable asset they have on their balance sheet. So I can't imagine that Congress, anyone wants to touch the home mortgage interest deduction. If they did, you could all imagine the giant sucking sound that would happen out of the American economy as values collapse and everything else. So it's not going to happen. I would sleep soundly on that. The state tax, currently we have an estate tax that at 40% for estates in excess of 5.49 million. Trump wants to repeal that and just have a straight capital gains tax on estates in excess of $10 million. This is kind of like the Canadian system. The House wants to repeal it entirely. The estate tax is really more of a political beast than an economic beast because it does not generate a giant amount of revenue for the U.S. government. But to repeal the estate tax smacks of, oh, you're favoring the really wealthy guys over the rest of us, because most of us don't end up paying estate taxes. This just shows you in bar graph who would win, who would lose, what happens. Right now, you see on the far left, 39 and 35%. Those guys who go to 33, they win. 28% goes to 25, they win. The 10% at the bottom, they lose because they go up to 12%. It's just a bar graph depiction. Capital gains, same thing. Current 23.8. That's really the 20% capital gains plus the 3.8 investment income. That would go to 20%. So a slight lowering under Trump, which he really doesn't revise capital gains. He gets rid of the net investment income, but then under the House blueprint, it would go quite a bit down. And they have a little bit of losers there in that gap where they're currently paying 15% and they go to 20% just because of the way the brackets work. Okay, so who would lose? Well, most people would save. Families with children, especially married, filing singly, had a household, those guys would get hurt. Here's the real kicker, and this is kind of the lie in my mind. It's just, I don't know the lie. And I'll show you the chart later, but I'll tell you before you see the chart. 47 to 48% of the tax savings under President Trump's proposed plans would be realized by which group of taxpayers? Yeah, the really, really, really wealthy. I heard wealthy. The top 1% get 47, 48% of the savings. And the graph is pretty dramatic. And mostly everyone else gets crumbs. So, and to be fair, it's kind of hard to craft anything because as percentages work, the top are probably going to realize more anyway, but that's a pretty extreme percentage under any scenario that I've seen over a long period of time. Okay, so we go from all those brackets to less brackets. What he would do in exchange for capping the itemized deductions is he would increase the standard deduction significantly. It would go up from $6,300 currently for singles to $15,000. We go from $12,600 for married to $30,000. Those are significant jumps. It's meant to simplify things and eliminate the number of people who would benefit from itemizing. Now we know, especially in this room, that the biggest thing in selling homes a lot is showing your buyers the impact that that itemized deduction of the home mortgage interest deduction. So I'm not sure how I don't know that he's going to win on this capping stuff. So, I mean, it's nice to say that the standard deductions go up, but those standard deductions pale in comparison to the mortgage interest deduction, especially with the values that we're talking about in our state. So we'll see what happens there. But again, remember the House says, no, we're not touching the home mortgage interest deduction. I don't think they're going to. I don't think you have anything to worry about here on home mortgage interest or itemized deductions. I think what you guys should be worried about in this room is what the heck's going to happen to the economy, just in terms of generally. Are people going to feel wealthier? Are they going to feel comfortable? What happens to interest rate? What happens to trade? Are they going to be insured? It's all those non-real estate specific things that can impact your ability to sell, buy and sell homes. I think that's really where the risk is, and that's what worries me more than anything else that the people in this room normally deal with. Personal exemptions would be eliminated. Families could deduct the new child care cost based on a state average. The AMT would be axed. The net investment income tax would be axed. Okay, we'd retain the 20% on capital gains. If the estate tax would be repealed. This is the one that shows cha-ching, that big bar on the right. That's the 47% that goes to the top 1% of the earners in America. It's scaled to top end. Now, we know there's a lot of us in the 200 to 500 range. You get a 2.9%, but 500 to a million up, they get the most. And then, it's pretty much crumbs across the middle class, but it is some sort of reduction. Here's the one that probably bothers me the most, and that's the 20 to 30,000. You see those red bars where you actually lose? The red bar means you're paying more tax. I know the president used the term that the House's Obamacare or Trump care tax bill was mean. This seems pretty mean to me when you're going to be increasing taxes on single family households. Okay, so this just shows how it works. The loss of the exemptions. I'll try and get us back on time here. Head of household, fare the worst. And it's just because of the way the brackets work and your loss of the deductions. Okay, and it's a single parent with one child would get 17,400 in deductions. Okay, and currently. Under Trump, they get only 15,000 with the standard deduction. So they're actually going down in the deduction, and the loss of deduction gets worse with each kid they have. And you can agree whether or not that's good or bad policy. It just seems, I just want you to be aware that there are this group, single parent households that are going to end up paying more tax under his plan. Doesn't seem fair, but that's the way it is. Corporate rate would be lowered from 35% to 15%. The U.S. corporate income tax rate is the highest in the OECD group of countries. That's the economic world. the first world, the developed world. We have the highest rate by far. Most rates and most of our the other countries in Europe and everything else, 15, 20% in that area. So 35% is really a ridiculous rate. I can tell you very few American corporations pay that rate. Certainly not the big ones. Why? Because they hire Harvard tax attorneys and we do corporate inversions and we reorganize their headquarters to the Isle of Man and other ridiculous jurisdictions so they can say, I'm no longer an American based company. So there's a lot of money being held offshore by big multinationals because they don't want to pay the 35% rate, which is to be expected. One of the things that Trump is proposing, which is intriguing and we're thinking about, is a special repatriation tax. Look, guys, bring your dollars back on shore. We'll give you a one-time 10%. That's pretty cheap. That could bring back trillions to the U.S. economy. Now, Trump, of course, is telling everyone, and that's going to create capital investment and jobs and spending and woohoo. Not so fast, because within a week after he announces, the CEOs of some of the largest top Fortune 100 companies got on the public radio and said, you know, we're thinking, yeah, that would be a good thing, but we already have enough capital spending. We're thinking about buying back our stock. That's not exactly going to kickstart the economy. So you can't really force how people are going to spend the money, but it makes sense. Let's get that money back on shore. U.S. manufacturers are given some benefits. Basically, Trump, a number of his tax changes would go towards expensing. In other words, taking current deductions for capital spending versus depreciation over a longer period of time. That would generate a fair amount of activity. Very expensive to pull off. I'm not sure how he's going to do that. We'll see. Most business credits would be eliminated, other than the R&D credit, which is kind of counterintuitive because R&D is one of the things that really keeps America innovative, ahead of the world, generating Silicon Valley and all that kind of stuff. But at the same time, they're slashing spending on science and a bunch of other things that are supported by government programs. So I guess the idea is let's leave all this stuff to the private sector. And maybe he's right. I don't know, but it's a little bit scary because I know a number of clients I have that do cutting edge volcanology, astronomy, maritime design here in Hawaii, and they're really worried about losing grants that allow them to do the cutting edge science that happens across this country. So we'll see. Okay, so we lower the rate. Here's an interesting item. He said initially pass-through entities, and you guys all know about LLCs and partnerships because a lot of your clients take title to their properties in LLCs and partnerships. If they take title in a C corporation, tell them call me and I'll yell at them because that's really stupid, usually. But what Trump said is initially, and we're going to apply a flat 15% to owners of pass-throughs until someone nudged him and said, those guys currently are individuals and their rate is 39%. And he said, oh, never mind, let's wait and see. Well, the latest proposal is that it'd be a 20 or 25% flat rate on owners through pass-throughs. Stay tuned. Keep your eye on what they do with pass-throughs if they ever get around to doing something on pass-throughs, because that could be a significant item for you in the real estate industry. Because again, most of your ownership entities for real estate should and are either LLCs or partnerships. If anyone owns apart from C corps, what's even worse is someone takes title in an S corp. Then you give me their number and I'll call them. Income inequality, yeah, there's just editorial. Nothing on capital gains, and there's some disappointment because that's really how we could probably address income inequality. Like-kind exchanges, let me talk just a little bit about that. He's talking about eliminating it, but again, like-kind exchange has been around since 1921, it's a long time. And you guys all know, for purposes of like-kind exchange, basically allows you to defer the tax. So you use an exchange intermediary. All the escrow companies, all the title companies have these, right? You don't touch the money. You tell the guy, take the proceeds from my house sale and go buy that other property or whatever property. And the thing about 1031s in real estate is real estate is real estate. You can sell a swamp for a New York skyrise. It doesn't matter. If it's real estate, it's real estate. U.S. Can't sell for foreign. But it's a big deal in real estate acquisition. So, I mean, in the real estate industry, what he really is proposing is something that is quite different, where he would say, you pay tax on the sale of your first property, but you get to expense what you spend on the second property. So if you do it in the same year, there's an offset, the gain versus the expense, zero tax. That's really, really significantly different. It also begs the question about what happens when you sell in one year and don't buy till the other because you have a mismatch. You got to come out of pocket with cash for the sale on the first. It's based on an economist's view of something that would be simpler. I don't see it gaining any traction. No one's talking about it. So if you ask me, 1031s are here to stay. But again, my opinion, and 250 will get you right on the bus. So lowering capital gains rates, I talked about. This just shows. Here's an interesting one. Look how the deficit projection really climbs under his proposal. And what he's hoping for is a stimulus effect. I don't want to call it trickle down or Reaganomics, but it's a stimulus effect by some of the stuff he's proposing. And I think if you were able to get his package through, which I don't know how he can because of just the budget balance issues, I have no doubt there'd be stimulus to the economy. Border adjustment tax. This is his Mexico stealing our jobs provision, and he would impose a pretty heavy tariff on imports and give a tax break to exports, and it's created a giant rift in the U.S. business world. Walmart is dead set against it because it makes the cost of all its goods really expensive. Boeing is 100% for it because it makes the cost of its jets and planes to the world a lot more competitive. So I don't know where he's going to get on the border adjustment tax. Territorial tax, that just means he wants to incorporate in the code this notion of which country gets to tax. Now, in the United States, what we do is we enter into bilateral tax treaties with our friends, our allies. We have a lot of different tax treaties, and what tax treaties do is it says who gets to tax the various types of income. And real estate's simple. Wherever the dirt is, that's the country that taxes it. So you don't have to worry too much about it. But he wants to incorporate that concept, which now is treaty based, into the code, which would give a lot of benefits to people that aren't necessarily so friendly to us. We'll see what happens with that. He proposes to eliminate the estate tax. I already talked about that. Let me talk a little bit more about 1031. A couple things I want you to understand. Number one, I already told you, always, if you're a seller, always say, I want to do a 1031. And brokers on the other side are not going to freak out because they're used to seeing that. And then you decide whether you really want to. Number two, if your client really wants to do a 1031, don't sign that a contract to sell until they have a real good idea about what they want to buy in replacement, because you have 45 days to identify and 180 days or the due date of the return to close. And I guarantee you that time goes by real fast. So you really should start the other way. Tell them by picking out 2-3 properties that they think they would want first, and once they do that, then you go and sell. That's the best way to do it. Sometimes they come to you and say, whoo-hoo, I bought my dream replacement property. Yeah, but you didn't sell your property. You're not stuck in the water, but you got to scramble. You can do a reverse exchange where you get the replacement first, but you're under that timetable where you have to sell your property, identify a buyer in 45 days and close in 180 days. So you can do reverse exchanges, but you got to scramble. And then the last thing, two last comments are, you can do construction. So you have to have equal value, right? If you sell for $1 million, you got to buy for $1 million. What if you see a property that's 800,000, but you want to put 300,000 of improvements? You can start constructing on that replacement property and have those capital improvements count towards the replacement value, but you're still under that time frame. So you got to get your contractors to hustle. So understand you can use construction to equalize values, but you got to hustle. That's the simple way to think about it. And lastly, if you have, here's a common fact pattern. We own the property in partnership or LLCs, and 2 of the guys want a 1031 and 2 of the guys want to cash out. What do? You cannot swap partnership interests for partnership interests. What you do in that scenario is the guys who want to do 1031 exchanges, They swap their partnership or LLC interest for a tenant in common interest directly in the property, and then they do 1031s. It's kind of complicated. Do not try this at home, ladies and gentlemen. You get burned. Call me if you're in that situation, or call a competent tax person, because you can get out of it. And it's not, it's a little bit of risk, but I've done it with very big properties. The IRS is familiar with it, and there's things you can do to mitigate that risk. All I'm telling you is, remember Mike said, when you have it in partnership, some partners want 1031, some want cash. There's a solution. Call me or call someone, okay? And then the last stuff is just some addendum. These are forms that you guys should be generally familiar with. I'm not going to talk about them. I don't know if I have a couple minutes. If there are any questions, I'd be happy to try and entertain them. If anyone has them, you just raise your hand. Great. Oh, I was almost off three. Okay.
Sorry.
That's okay.
I'm kind of intrigued by your last comment about the construction being added on to the 1031 value. When does the construction? What happens after that 180 days? Does the construction have to be completed, permits signed off, or money?
Construction has to be placed in service.
Okay.
In other words, it has to be completed and usable. To the extent that you've spent that money and it's usable, then that counts towards the value for your 1031 purposes. So 6 months is not that long, right? But whatever you can get done and built in 6 months that's usable,
It
you
takes
can
you
count
3
towards
months
the
to get a permit, so that's what I'm.
That's why you got to scramble.
Yeah.
So construction is not an end all and be all. It has helped in cases. What usually what ends up happening is you get enough construction done that you mitigate some of your taxes and you don't eliminate all of it, so it helps. Sometimes if it's only a little bit of construction you need, you're home free. But just understand that that's available to you. So the timing is the thing about 1031, very mechanical. The deadlines are the deadlines. You can't tell them, man, my cat ate my paper. Can I have another day? You can't do that. It's 45 days, it's 180 days, end of story. So it's very mechanical. And that's why when you get to these complicated structures, you really do need an expert to help you through it. But I know there's guys out here in the audience that probably know a whole lot more about 1031s than I do, because it's just the way to go. And in Hawaii, we have so much extremely high value, effectively zero basis real estate, right? These families that have owned property for generations, and it's worth gazillions, but they don't have any tax basis. Anyway, thank you very much. I've enjoyed it.